Welcome back, everyone. We're so excited that you're here for another episode of the Never Broke Nation podcast, where we're here to help you make, save, and grow your money. I am one of your hosts, Janai Thornton, here with Chris Hollis. And we are here for part 2 because part 1 was so amazing.
Yes.
Yeah. I'm ready to go by, Chris.
I learned a lot. I'm still sad, but I learned a lot.
We are here for part 2 for all things mortgages today. Hey, Micole, our special guest.
So now, what does refinancing mean?
So refinancing is a new loan. You're taking out a new loan to replace the current loan that you have. Normally, it's for the purpose of either reducing your rate or pulling out equity, which equity is the value of your home versus the amount of money that you owe. Okay, so the difference between the two is what it is. And if you're lucky, you can do both. You can get a lower rate and pull out equity.
Wow.
So.
And how do you know you're a candidate to refinance?
Well, like I said, it depends on what purpose you're using it for. So for the purpose of rate, if the rates are generally the rule is a point and a half below where you are before you refinance, before you can see the biggest financial difference. Now, if you're doing it for the purpose because you want to pull money out of your home, any reduction in rate is going to be beneficial for you because you're really doing it for the purpose of acquiring the equity position. You typically don't want to go up in rate, right? That wouldn't necessarily make sense.
Right.
But any reduction in rate, if you're pulling equity out, is beneficial.
Now, is refinancing, is the process different if you have like a FHA loan versus a conventional loan?
The process is still the same.
Okay.
The loan to value percentages can be different. So FHA will not require you to leave as much equity. So, for instance, you have to leave some. You can't tap it out 100%.
Okay.
So normally the level is between 15 to 20% of equity if you're pulling money out. We can do some as low as 10, depending on the program. But in your credit score and things of that nature. So
Got it.
When people are going to make the decision to refinance, obviously it costs to refinance. How do you know that you should do it? Because, I mean, obviously you want a lower rate.
Right.
Maybe you're accomplishing that, but, you know, what other factors should folks be thinking about?
So the closing costs that you pay when you purchase or the seller has paid for you when you purchase, they're still there for a refinance. The only difference is you're rolling them back into your balance typically if you don't want to pay them out of pocket, which most people don't pay it out of pocket. They roll it back into their loan. So that's where the point and a half comes in because you want to make sure you're getting the benefit of the closing costs and increasing the balance, not offsetting the purpose of you refinancing to reduce your rate.
Right.
So that's why typically, you know, the 0.25%, the 0.5%, you're not going to see as big of a difference because you got to bump your balance back up with the closing costs.
Because you're adding that back in.
So you're not going to see as big of a difference in that payment, even though you're reducing the rate, unless it's a bigger decrease in the rate.
I've always heard that refinancing, and this is just probably a myth, but refinancing extends your loan.
You can, well, it will, depending on what term you decide to refinance into.
Right.
So if you are 30 and you've been paying on your loan for 10 years, but you want to refinance it back for another 30 years, then it's starting you back over. But it's taking the balance and spreading it out over a longer period of time again, which is what makes your payment lower. And if that's what your goal is, then that's what people do. But you can reduce the term. If you were 30 and you paid 10 in, you can do a 15-year mortgage or 10. You don't have to go back to 30.
Is 10 years like the normal length of time that you stay in a house before you try to refinance?
No, you
can do it like at what? Like at year
one? You can do it as
one?
early as a year out if you want to.
It's just all about the rates.
I haven't had to do that part yet, so I'm not as familiar with it.
And you may never have to.
Right.
That's not something you have to do.
Right.
It's not a must.
Because if you have a good rate.
Right, if you have a good rate.
Speaking of
it's
good
fixed.
rate, what is a good rate?
Well, you know, that depends on the day.
Yeah.
That's relative. You know, they've gone up in the last few weeks now. So we're high 4s, low 5s. So let's just say a range of 4.75 to 5.25, depending on your credit score.
Right. And know people, they are changing literally every single
They
day.
are.
So,
Right.
yeah.
That's true. That makes sense. That makes sense.
And so what, I know we asked you before about what frustrates you with new buyers. Like what with refis, you're like, come on, people.
Kind of like what Chris said, they think that they have to refinance at some point.
Right.
And I get a lot of inquiries in refinancing, and I'll tell them, because I'm not going to waste your time or your money. And what I normally will do is show you the differences. This is what it looks like now. This is what it will look like, and let you see for yourself. Like, it doesn't make sense. It doesn't always make sense to refi. That is the biggest thing, because, lack of knowledge of your value. That is what it is. I mean, I have a lot of people who think their home is worth way more than it actually ends up being. And, once you do the appraisal, that's it. I mean, and sometimes it doesn't work out, which is, frustrating, I'm sure, for them. But, in this market, though, Janai, I don't do a lot of. It's just not.
It's not happening.
The rates are not where they need to be for people to do it.
Right.
Oh, it's not. I don't see a lot of those.
So besides equity, and besides lowering the rates, there are no other reasons people would refinance a house that you've came across?
Lower rate, hopefully meaning lower payment.
Lower payment,
Right.
paying off debt, which is still pulling your equity.
Exactly.
So you can
Pulling
pull
out.
equity out to pay off debt, to do improvements to your home.
Yeah.
So those are the three major things that people do: either reducing their payment, they need to pay off some debt, or they need to do some improvements to their home.
So when they pull money out, again, this is my ignorance. When they pull money out, when they pull the equity out, what does that do to the home loan? Like, does that mean, okay, if you had a $200,000 house and you took out 50, are you back at 200?
If you have a $200,000 balance on your loan, and when you purchase your home, let's just say it was $220, and you by the time you put your down payment or whatever, but now your home is worth $400,000.
So that's the difference.
So now you have $200,000 in equity. But remember, we're not going to let you get all 200. You have to
Exactly.
still leave a position of equity in there. But if you can qualify, you can get whatever that difference is up to that max. But that's what your new loan amount will be, whatever your current balance was, plus whatever you choose to take out.
So if your home has decreased in value,
Then you can't
have-
refinance.
yeah,
No.
I understood.
Yeah.
we're
And that's
not
what's
gonna-
hard for people, because that's what Micole talked about, when people are shocked, they get their appraisal back and it's not what they think, or you hear about people being upside down, you owe more than what your house is worth. You're not refinancing.
No.
'Cause why would the bank do that?
Why would we do that?
Yeah.
Right.
It's like, why are we going to give you money on something that's not worth as much as you owe on
And
it?
is the money yours? Once you take that equity out, is it yours?
Yes,
So
it's your
you
loan.
you don't have to pay, but you do have to pay it back.
You are paying it back.
Yeah.
Oh, never mind.
Yeah.
Never mind.
What you trying to do over there, Chris? I don't know. I'm just like, she got something going on over there.
The only way to get the money is yours to sell your house.
Right.
Then,
Exactly.
then
That makes
it's
sense.
yours. Yeah.
Right. So this is an ongoing discussion in my household. My husband, David just sent me this note. So, because I wanted to spend a little bit of time talking about investors.
Okay.
Right. So she's like, where are we going here? Right. So we inherited a property several years ago that has a mortgage on it. And so we have a lot of equity.
Okay.
And so he's always like, maybe we should take out some of that equity to buy something else.
Okay.
So I know you deal with investors.
Yeah.
Is that common? Do you see your investors pulling equity out to make investments in other properties?
Yeah, I mean that's not a common situation what you're in, but
Right. It's not really?
No, I mean people don't just get left houses sometimes with a whole lot of equity.
She's like, what?
But if you are fortunate enough to be in that
that's
situation,
right.
Yeah.
I mean that would be the smarter thing to do, actually.
Right. So take the money and flip it. Look at him over there.
I'm not
I know,
gonna
like,
David.
I wish I could turn the camera around.
when I saw him ask that question, I almost wanted to write a big thing like, no, I'm not going to ask it. No, I'm not asking.
Funny.
It's a wrap now.
I
John.
know.
Yeah.
Oh, trust me. Now, and more importantly, you know what he's saying? I'm right.
I'm right. I'm so sorry.
I've been right the whole
And
time.
if she bring it back up, David, just pull this video back up and just like, remember when Micole said this?
Micole said. Thank you, David Thornton. But let's talk about investors, though, because obviously, real estate, people have always thought this is the way to make money.
Right.
I can make a lot of money. I can make extra money. What advice do you have for people who, they're interested in this, from a loan perspective, who think they want to, really get into this?
Well, the investor world, you have to be very prepared financially. Let's say this. And that's what I see a lot of people who want to be investors, but they don't really understand what that means. So if you're going to be an investor, that means you're prepared to make that mortgage payment if you have no one there to make that payment. As a renter, if there's something that happens with the home, you're responsible for it. So that we do require at least 6 months of we call reserves for investment purchases, and a lot of people don't know that. Okay. So that means you have to have not only the down payment, which is a minimum of 20%. So it's a larger down payment because it's a high risk loan.
Right.
If something happened in your life, what are you going to let go first? Your primary or your investment?
Right. The house I don't live in. Yeah, just like they can figure it out.
Yeah.
Right.
Right. 6 months reserves, 20% down, typically somewhere around almost a point higher in interest rate as well. So it is for your more well-qualified buyer. So that's the biggest advice I would give people is to make sure you have to be financially prepared for it.
And then how many mortgages can you have? So if I want to have 10 properties, what's my limit?
You can have up to 10 finance properties. Now you can have 50 properties, but 10 finance.
We can find. Oh, I didn't realize it was that high. Yeah, I don't know. I thought it was lower than that.
So 10 is the max?
10 is the max. It used to be 4.
I know nothing about investing.
Right. No, I don't either.
I can't chime in
right here. No, I don't either. But I just know, for people, I think culturally, for Black people, we have known people that we know who have money. A lot of times we can associate it with real estate.
Right.
That's kind of normal and culturally accessible to us. Like, oh, we know so-and-so who owned a couple of houses or owned a couple of buildings. So I think, it's why, people are like, oh, I can do this.
Right.
But what does that mean to get into the game? It's particularly now when you're not just paying cash for something.
Exactly.
Right. Yeah, if you're using someone else's money, how do you get qualified for
that? And you can, but it's just like everything else, preparation, planning for it. And because if you're going to be an investor for the purpose of, there's different types. There are people who just have rental properties and they're generating a lot of rental income. And then you have people who buy properties and they fix them and they flip them. And then, if you have a situation, a lot of people that have done that and you're successful with your first one, then that just sets the standard, the precedent for you to do the next one and next one and next one. And that's how you can generate even more and more money.
Right.
Is there a difference in the process if you want to buy land, like with that doesn't have a home on it? Like maybe you just want to buy the land for a commercial property. Right.
So, yes, that's a totally different type of loan. A lot loan is what it's called. And they do, most of your banks or your smaller banks, we don't do lot loans. Now, we do construction to permanent loans, which is when you're building your own home on the land that you own. Because we're going to combine the two loans together into one. But a lot loan, most of the time, the guidelines for those are even more restrictive than anything else we've discussed, which is why most people pay cash for their lots.
Yeah. So what have you seen your investors do wrong?
Not be prepared financially.
Right. Yeah. Not know about that 6 months.
Right, exactly. Not knowing about that, not being prepared if there's no one in the home. If you're going to be somebody who flips, not being prepared for everything that can go wrong with that home when you're in the process of trying to renovate it. Cash flow is extremely, extremely important. That's why you see things that are started and not finished because
people run out of money.
They run out of money because they didn't prepare.
Are people who are flipping typically financing?
Most of them are not.
Okay.
So they're like buying it with cash,
Yeah.
and flipping it and trying to sell.
Okay, got it. I was gonna say, by the time you got finance, you should be, getting the property done.
A good flip, you're going to spend a very small amount of money for it,
Right.
and then you have the liquid you have the cash to make it
to make
great.
the upgrades.
Yeah, and then that's where you make your profit.
Yeah.
So let's talk about what I started talking about from the beginning: the people who are in trouble. So we have
okay.
people who have filed for bankruptcy.
Bankruptcy.
We have people who need to do a short sale, want to do a short sale.
Now, what is a short sale?
A short sale is when the bank or the mortgage company allows you to sell your home for less than what you owe on it.
You need to get out.
Yeah,
Yep. And you can't sell it for.
you're
What you owe.
you're underwater.
Yep.
Yeah.
Yeah.
And so what does it take? I have a very close friend who's going through this right now. What does it take to be qualified for a short sale?
Well, that's going to depend on the lender, and I've never honestly been on that side of the mortgage world.
Okay.
Because that's more of a servicing type thing. But they all have different requirements as to whatever they're going to. Some mortgage companies or banks make you go behind,
Right.
and that was very common,
Right.
when the market fell.
What do you
And they
mean by go behind?
Meaning they don't consider you eligible for a short sale, or they don't consider it a hardship unless you haven't made your payments after a certain amount of time.
So sometimes they'll tell you to stop paying.
Yeah.
Yeah.
Yeah,
Just
in order to qualify for a short
Right.
sale.
Yeah, it's typically one of the criteria.
Right.
Yeah,
Stop.
unfortunately.
Yeah.
The biggest thing is to make sure that the home is definitely not worth what, you're not trying to make any level of a profit on it anywhere.
Right.
And, right now in Atlanta, we don't have that many. The equity positions have improved dramatically.
Because the values are so good
Yeah,
now.
so we don't see as many short sales as we used to. But, depending on who you had, were your friend,
Right.
they would have to tell them what they need to do
Right.
to be able to qualify for a short sale. Now, if you have a short sale and they don't make you go behind, then we look at it totally different on the mortgage side, which is the unfortunate part. Once you get over 90 days behind, then it's like a pseudo foreclosure.
Mm-hmm.
We have to treat it like you foreclosed, like they took it from you versus you selling it.
Right.
And that's the unfortunate part for somebody who's just trying to sell something that's not worth what they owe.
Right. For people who, lost a job, got sick, some major family, something happened, can't pay their mortgage anymore. They're getting ready to get behind. What do they need to do?
They need to contact the mortgage company and try to get them to work with them. I mean, a short sale is still always better than a foreclosure.
Okay.
So, so even if it's not a situation where the home is underwater, you just can't pay it, you can still sell it.
Right.
I mean, sell it. I mean, why would you, if it's not underwater, that's even more ridiculous
Yeah.
because you're giving away money.
Right.
Yeah.
Just sell it. That's not even a short sale.
Right.
Just sell it.
Downsize,
Yeah.
essentially. Right.
Yeah.
Get from underneath it. Okay. But I guess communication before things start.
Communication before it gets too far gone.
Right.
Yeah.
Okay. And so for people out there who say, I filed for bankruptcy and I'm never going to be able to buy, is that true?
No.
No.
Absolutely not.
Like, so, I don't know if there's some standard. Typically, how long after bankruptcy?
2
can you buy?
years.
Oh, that's not bad.
FHA, 2 years after bankruptcy,
That's not
after
bad.
discharge date. No.
And conventional is how long?
Conventional is 4.
Okay.
Okay.
2 years after for FHA, 4 years for conventional.
That's
not too bad.
I mean, yeah, that gives you enough time to get on your feet. Yeah,
Absolutely.
kind of pull things together. Yeah.
Just start rebuilding credit. I mean, in some situations, I can't advise people this as much as I've wanted to. If you have hundreds of thousands of dollars in debt, I mean, that's what you really need to do.
Right.
And then just start over fresh.
clean slate.
Clean
Right.
slate.
Right.
Rebuild your credit.
Right.
And then you're able to purchase.
Going back to an FHA loan, quick question. Can you how can you refinance out of one of those?
Yes.
So what would that take? Or you just
It's no
just
different.
go and try
Yeah.
to refinance?
Mhm. As long as you have the, enough of the equity position and the credit score requirements for a conventional loan, yes, you can refinance. People do that in order to get out of that mortgage insurance factor. Because for I think I said it in the beginning, a lot of FHA loans is there for the life of the loan now, versus for conventional, once you get to a 20% equity position, you can get the mortgage insurance removed. So some people, if you're in a situation where you need FHA to get in the home because of your credit, but you've improved things, then yes, you can refinance it into a conventional loan. It just has to make sense, just like everything else. The rate and everything will need to work for you to do it.
That makes sense.
Yeah, I have just a couple questions for you, Micole, about costs. Then I think I've covered everything.
Yeah,
I've learned a lot. I mean, like, dang.
I've learned a lot.
I know it. So when people are thinking about buying a new home, when you think about closing costs, like what does that mean? What's in there?
Closing costs consist of any lender fees, so the fees that we assess to be able to do the mortgage, and then you have your attorney fees and recording fees. So those are the other things. So title, of course, the attorney to do their job of closing the loan, and then the state has fees that we have to assess to record your deeds and title and pull title and things of that nature. So typically, the closing costs can be anywhere from 3 to 4% of your sales price. If you just want to use that as a rule, the lower the loan amount, though, of course, the higher the percentage, because certain costs are constants. It doesn't matter if it's a $500,000 home or a $50,000 home. The fees for the attorney and our lender fees, they're the same.
Right.
So those are, and then the other part of costs that people tend to forget are the prepaid expenses. So prepaid expenses are the fees used to set up your escrow account for your taxes and your insurance. And they are also part of your funds needed to close. So you have closing costs, prepaid expenses, down payment. 3 different areas that all total.
Wow. I have one more question, Janelle.
Yeah.
Going back to something.
Oh, yeah.
So I have a friend who his insurance is not included in his mortgage.
Not escrowed, right.
Is there a way he can
Not after closing.
not after closing?
If his insurance isn't included, typically taxes aren't either. Does he pay
Right.
those separately as well, or you just?
I don't know.
Yeah.
I just remember them talking about the fact that they hated that they have to pay it separately.
But they chose to do that.
Well,
At closing.
maybe
right.
now he's smarter. You know what I mean?
Yeah, because
But I didn't know if there was something he can do where it can get included. So there's nothing.
once you close on the loan, the way the loan is set up, the servicing is set up, you can't change that. So like I said, it's a cost. I mean, people actually pay a little bit more to do that. So the fact that he doesn't want to do it is interesting now because he made
because he
that
chose
choice to do it. But,
So mortgage companies don't prefer that you escrow? Because I was just
they do prefer you
I was getting
escrow.
ready to
That's
say,
why I say it's a cost to not escrow.
particularly like for the insurance, because I feel like as a mortgage company, like I would want to know that your insurance is being paid. Yeah.
Now this person has been in this home for like close to 25 years. So I don't know if things might have been different then.
Right.
You know what I mean? But I just don't know. But I know
You
they
should
were
be
trying to
almost
get it.
finished, right?
Yeah.
Yeah.
Yeah. So
How about that?
you'll have to pay it anyway,
Right.
and the taxes.
So, I've heard about several different programs or apps where folks that are renters, that if you sign up for the service, that now you can actually get credit for your rent on your credit report. So is that actually true? And does that help people get qualified to buy?
We are seeing more apartment complexes or landlords that are putting that on their credit. It's listed like an installment debt. So to be perfectly honest with you, I'm not 100% sure how much of an effect it's really having on the score. We don't, of course, use it to qualify you because it's not going to be a debt you have when you purchase the home. But they are adding them as trade lines on the credit report. So, I mean, if you do have a landlord that's adding that you want to make sure that you focus even more on paying it on time.
Right.
Because it'll be reflected just like it would if it was an auto loan
Gotcha.
or a credit card
So
loan
what did
if
you
it's
mean
not
by
paid.
trade lines?
So trade lines are your credit lines. So your American Express,
Accounts.
your car loan, whatever. Yeah, they're your accounts. That's synonymous with your accounts that are being reported to the bureaus.
So it doesn't matter if you've paid your rent perfect for like 3 years straight. It doesn't matter because you're not really going to be. That's not going to be taken into consideration.
Unfortunately, the more they try to make the guidelines a little bit more lenient, they're not focusing as much on that. I know that doesn't really make sense, but it used to be a time where we would get rental histories, and if it wasn't satisfactory, that could be a denial factor.
Right, that would make sense.
Right, but now almost every loan is run through an automated underwriting system, a computer system, and so it determines whether or not the rental history is required as a qualifying factor. And if you're getting an approval through that system, which you have to get in order to be able to qualify, it doesn't ask you for a rental history. There are very small exceptions now. If we are doing something more like a manual, where we're taking the computer out of it and it's the human being factor solely, and we're looking at you have to have certain debt to income ratios, certain amount of assets, then rental income does play a part in it. But over the majority of our buyers, it really doesn't. I know.
Yeah.
I've heard of people trying to get their complexes or renters to write letters. I've heard some of everything, and like you said, with the apps and things that you can use now,
and people are paying for that service typically.
Well,
That's
need
not
to
always
stop.
free.
Right,
To
it's not
get
as
that,
beneficial.
to get that reported, it's not always free. So you want to know. You would just assume it's going to be helpful, but if I'm paying extra to have that happen,
and it's not going to have an impact on
no
our decision.
impact, then that's just a waste of money.
I'm glad we talked about that.
Yeah, that's very good.
Yeah.
All right, my last question. Common myths. You're like, where do people get that from? Like, who said that?
Oh my goodness, that's gonna catch me off guard.
Right. Anything that you're like, that is not true.
That's a good one, Jenna. I can't think of anything off the top of my head.
Nothing.
I'm sure. I'm sure
there's just so many urban myths, because there's so much fear around home buying. There's so much fear around money. People just make up stuff, and I'm like, where do people get this from?
Oh my goodness.
Like, who said that?
I don't know. I mean, the biggest thing, of course, what we talked about with the credit, where they think just because I don't owe anybody, so I should have great credit.
Right.
I get that a lot. Especially with my older buyers.
Right.
No.
What do you mean? I've been paying on this, or what I can afford $1,200 in rent, but you will only qualify me for $500 for a mortgage. They think it's equal, but it's a totally different process for what the rental company, what they use to qualify you, and what we use to qualify you for a mortgage.
Right.
But I don't know. I mean, I'm sure there's probably tons of things out there that I've seen and heard that would blow your minds.
Right.
I can't think of it at this moment.
This is always an interesting area.
Yeah.
Micole, I'm so happy you came today.
You had me.
No. We learned a lot. I know our listeners and viewers learned a lot. So tell people again where they can find you.
Social media.
Yeah.
Facebook, the Sudduth team, and LinkedIn is Micole Sudduth. I'm assuming I told y'all I'm horrible about this.
Right.
And Instagram
We'll make
is
sure we put it
MS
in.
Sudduth. Yes.
Yeah, we'll make sure we'll include it in the bio.
It'll include
as
in the
well.
bio. So people will see how to spell that last name too. They're like, Sudduth, like
yes,
what?
yes,
Exactly.
What the heck is that? Well, thank you everyone for tuning in to the Never Broke Nation podcast. Chris, can you tell everybody where they can find us and follow us?
Yep. As always, you guys know we are at Never Broke Nation on Facebook, Instagram, and YouTube. And you can also download our podcast on iTunes as well.